This is Conversations, a weekly financial podcast featuring interviews with leading investment strategists, noted technical analysts, and other key thought leaders. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA Podcast Series, and today's guest is Jason Goepfert. Jason Goepfert is President and CEO of Sundial Capital Research and publishes at sentimenttrader.com, dedicated to the application of mass psychology to the financial markets. The work of Sundial Capital Research has been mentioned in publications such as The Wall Street Journal, Bloomberg, Barron's, CNN, The Economist, Reuters, CNBC, SFO Magazine, Active Trader, Futures, TheStreet.com, Trading Markets, and many others. After attending the University of Minnesota with a concentration in finance and economics, Jason helped build the online brokerage operations of a major U.S. bank from 5 people into over 300 and a top 10 ranking. Then Jason moved to help run the operations of a large hedge fund before founding Sundial Capital Research in 2001. Currently, sentimenttrader.com has subscribers in all 50 states and more than 50 foreign countries. Jason is also a contributing writer to the Emmy-winning site Minionville.com and provides private consulting for hedge funds and managed accounts. Jason is also a winner of the prestigious MTA Charles Dow Award. Welcome to the program, Jason.
Thank you very much. I appreciate it.
Your bio reads a bit like a movie. I happen to know that you went from the mailroom at the brokerage firm, and you went from there to, growing. You went from the mailroom to growing the brokerage firm from 5 people to 300. From there, you went to a hedge fund, and now you have your own company. And as I was reading that, I was thinking about former General Electric CEO Jack Welch said that you have to get out of the pile at a company to get noticed in your firm. How did you quickly move up the corporate ladder?
Well, first of all, look, the timing was good. This was in the early to mid-1990s. The discount brokerage area was just kind of starting to take off. And I got in with, what was then Norwest, but now Wells Fargo. And they were they had this discount brokerage offering, but they hadn't really done much with it at all. And then the online trading thing started, and we had this very bare bones online setup. I mean, literally, you would go onto their website to place an order. We would print off that order onto a printer, and then we would manually enter it. And I mean, you can imagine that now. If you go on to E-Trade and you're imagining your order printing up on some printer, somebody runs over, prints it off, and then goes into this. It was just a really clunky terminal too. The thing we had to place an order. It was really. I mean, you would be aghast if you saw it now. So
the trade execution's any faster than picking up the phone and calling your broker? It sounds slower than what it was.
Yes, actually it was, because we were so short-staffed that the wait time, and I'm being perfectly serious for this, even for an option order, sometimes was 45 minutes. So we had this one large trader in particular from Chicago. He had a multi-million-dollar account. I think it was by far our largest account. He would call in, and we had no way to prioritize calls. So he would just go into the queue, and literally sometimes he'd have to wait 45 minutes just to get on the phone with one of us. So by the time I became a supervisor there, obviously I got escalated calls quite a bit because he was never really happy with the service at that point. So it was, the good thing about that is it was a tremendous learning opportunity. I mean, literally I think there were 5 people there when I started. And it just happened to hit the timing right, and by the time I left, there were over 300. So there were obviously challenges with that. Like I said, a lot of difficult customer service conversations and things like that. But the other side of that, it was I got to learn every piece of the business. So seeing the margin accounts and the option accounts and doing the trades and customer service and just the whole operations of the brokerage firm. Being so small, I got to learn everything. I got all my licenses, and then as it grew, went into more of a management role. But that was I wouldn't give anything for that experience. So, starting off at the mailroom, it was kind of an ego hit at the time, but I mean, I was young and poor and literally had nothing to lose. So I figured, this is what I'm interested in, so I'm going to, kind of take the bull by the horns and get in on the ground floor and see what I can do. And I'm really glad I did that.
Now, your focus is on sentiment, and we know that sentiment indicators can often stay at extremes longer than we would like. How have you effectively taken optimism and pessimism and turned them into timing tools and risk management tools?
Well, first, it's an important part is to quantify as much as possible and test. And often when people talk about sentiment, it's very qualitative. They're talking about their neighbor was talking about a stock, and so, everybody's optimistic, or, the cab driver or whatever. And it's always come from a very qualitative place. So I think quantifying as much as possible has been a big help with that, and even just basic statistical testing. Just because you have the data doesn't mean it's necessarily valid or useful. So those two things, also taking the trend into account, has been a big part of that. So if we're seeing optimism in an uptrend, that isn't necessarily the same thing as optimism in a downtrend. And we do see that, a surprising number of times where we'll get extremely pessimistic readings when the market is still relatively healthy, and vice versa. So those are the times where it tends to be most effective. And so incorporating some kind of trend filter as a stop against that extreme can always become more extreme kind of danger is an important part of it. Another point is using sentiment more of a setup as opposed to a trigger. So just because we have extreme optimism isn't necessarily a trigger to sell or sell short especially. It'll be kind of a heads up that, okay, well, conditions are deteriorating here, risk is rising, so if we see some kind of a price deterioration or other trigger, that would be the actual point of entry for a trade.
Okay. Well, let's talk about idea generation. You have a unique way to consistently assess where we're at in the market today and measure and test when that exact or similar occurrence has happened in the past, and measure what would likely happen in the future. How do you come up with these ideas, and how do you do that?
Well, I read a lot, and not really the more common blogs and news sources and things like that, but I try to read very widely and just ask constantly kind of why, or how can I apply this, or what would be the implication if that was applied to the current market. So I think just being really curious and using a critical eye for pretty much everything that I read is a good way to do that. And a lot of times it results in nothing. I mean, I've got this spreadsheet graveyard on my computer where it's just these, all of these things that I was so excited about, and I was like, oh my God, this is going to be such a great development, and you work on it for hours and hours, and then it's like, well, that was a bust. There was absolutely nothing with that whatsoever.
Yeah, the Holy Grail graveyard. I have one of those too.
Yeah.
How frequently? I don't want to take off on a tangent, but how frequently does that happen, where you go down a path and it leads to nothing, versus where you go, okay, this is worth putting out there?
The vast majority of the time, I would say 98 out of 100. I really would. It's amazing how often things just don't work. With that, though, there are a lot of things that could work, but I don't feel comfortable using it. And we can maybe get into this later, but a lot of that has to do with confirmation bias, where for the things that I'm looking at, I'll have a particular market view based on, the risk that I see. Well, then I have a tendency, and I think most of us do, to use another study to confirm that. And so a lot of what I run into is I'm looking at the study, and I keep trying to drill down, trying to find a particular bias from that data. And so I'm constantly checking myself against that. And so a lot of what I reject, I just feel I'm searching for something in the data. And so I'll reject it out of hand because I think I'm stretching. So a lot of the stuff that I look at and reject could be valid, but I just don't feel comfortable using it because I think I'm being biased.
Okay. Now, a lot of your results are measured against better or worse than random. Can you tell me about that?
Really, for that, all I use is an average during the study period. So if the data that I have went from 1998 to the current, I'll use average returns during a 1-month period or 3-month or whatever I'm looking at during that study period. There are other ways to do it. You can use Monte Carlo simulations or something like that, but I find that just using an average during the study period is a good check against what your study results are. And so against those, I'll check for significance. I do obviously prefer that something be significant from a statistical point of view. So look at p-values and z-stats and things like that. And you've got to look at sample sizes. I think that's one of the dangers that me especially run into is just small sample sizes. A lot of the things, especially over the past year or so, that we've seen have not happened that many times before, 2 or 3 or maybe 6 times, and you can't rely a whole lot on that statistically. So some of the things that I write about are not valid from a statistical point of view, but not everything necessarily has to be. So I'll try to point that out when I write about it, that it's kind of a heads up. It's similar to our current situation, but it may not be. If you run it through a math program, it's going to come out well. That's not valid. So,
what kind of a sample size do you need to get comfortable with it?
Well, I would prefer 20 to 30 at a minimum. Ideally, you'd get up close to 100 or more, and that depends on how much of an outlier data is. If you've got a sample size of 12 or 13, that could still be valid, as long as the results are deviant enough from average during the study period. But with that small of a sample size, you've got to have really consistent and really deviant results. But like I said, a lot of the things, and part of the problem too is that a lot of the sentiment data only goes back to 2002, 2000, 1998, 95, thereabouts. So 20 years of data is about the maximum for many of these things. A lot of the stuff like margin debt and short sales and stuff goes back nearly 100 years, but oftentimes that's not very good data, quite frankly. It's a lot of the newer innovations in sentiment data that are coming out in terms of ETF fund flows and options data is relatively new. So that's great. It gives us a better look at where traders are putting their money. The bad side is that we haven't had too many market cycles to analyze that through.
Right. Well, besides sample size and limited ETF data, what challenges are there in using quantitative and statistical analysis?
Well, I think the main one is what I touched on with confirmation bias. I think there's a real danger to focusing on data that we want to based on whatever market view we happen to hold. So that's not specific to using Excel or something like that, but I think it's probably the number one thing before you sit down and start running these tests is, am I doing this to confirm something I already believe? You look at some of the better known pundits out there, and they'll trot out some of these statistics, and it's very specific. They pick these certain thresholds because that's what's going to make the study results what they want them to be. John Hussman is a perfect example with that. I have huge respect for John Hussman. I think he's generated really good returns and done well by his shareholders. I think his approach is very good in terms of taking a critical eye to things, but his data mining is unbelievable. I mean, he'll take these very specific things because they happen to match certain criteria that he wants them to match. So I think doing things like that is a big danger, and you've got to be aware that you're doing that.
Well, let's talk about the markets. There's always something interesting going on, but it seems right now both bulls and bears have something to point to justify their positions.
Yeah.
Tell me what you see going on in the markets.
Well, I think starting in January in particular, we had a pretty classic topping cycle. And by topping cycle, I'm not talking about 2000, 2007, where we're going to see a 50% bear market. That's not, I don't think we're seeing conditions anywhere near like we saw then in aggregate. But in terms of a pretty classic 10 to 15% pullback correction, we were seeing very classic signs of that in terms of there was a peak in sentiment and optimism in early January, and then a retest of those highs with lesser sentiment. And that's very often what we see. And then the breakdown in prices confirm that. The interesting thing with this one is that, if you look at the S&P or New York Composite or anything like that, we're basically been flat. There was a 5% dip in there, but the NASDAQ and Russell 2000 have been much more reflective of that classic cycle. So that's a real challenge here is, are the NASDAQ and Russell the ones that are really reflecting what's going on, or is it the S&P that's close to a new high right now? So that's a challenge. I mean, the S&P should have been correcting more now based on the types of conditions that we were seeing earlier. So personally, I think, that's going to be difficult. That whole sell in May thing, everybody's jumping on that bandwagon, which makes me nervous. But just on what we've seen, it does look like the risk is more skewed to the downside, at least for the next few months.
So Jason, before we go, I want to give you the last word. Is there anything you would like to add before we sign off?
I would like to just kind of have a warning about trying to make an assumption about what we think everyone, quote unquote, is thinking based on what we read on blogs and Twitter and et cetera. I think Twitter is especially a culprit in that we follow all these people, and so we think we kind of have a read on what people are thinking. But the danger in that is that we've never had this before. We've never had this kind of dissemination of opinion before. So, and Twitter and the blogs that we read are a self-selected sample. So we're picking the people that we're looking at these opinions for. So I think it's very easy to, if you go through your Twitter stream or whatever, I think it's pretty easy to think, well, everybody thinks stocks are going to rise or everybody thinks not. That's a very dangerous way to go about gauging sentiment, because it's just, it's very, well, qualitative, but it's just, we've never seen this before. So making an assumption based on that is highly dangerous. So as much as possible, I think, trying to get the underlying data to put that into a more quantified stream is a good idea. StockTwits, I think, is doing a good job with that with their sentiment for Twitter streams. So as we get more data with that, I think it's going to be much more beneficial. So I think just being wary of knowing or assuming that we know what everybody thinks based on what we're reading is really dangerous. I'm seeing a lot of that among people that I know, just based really off their Twitter stream. Well, that's not a good way to go about it. So trying to get some data, doing even some basic analysis, I think is a much better way to get a feel for what people are thinking out there.
If somebody wants to get a hold of your research, what is the best way for them to do that? I'm assuming you don't have a Twitter stream based on what you just said.
I do. Yes, it's Sentiment Trader, or just search for Jason Goepfert. So, and Sentiment Trader only has one T in the middle. That's a whole thing we could get into. But yeah, either that or just sentimenttrader.com, or just a Google search, anything like that.
Excellent. Thank you for your time today, Jason.
Yeah, anytime. Thanks, Lance.
Today's guest has been Jason Goepfert, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.